Welcome to our fourth and final video, The Psychology of Money by Morgan Housel. In this video, Morgan takes us on a fascinating journey through understanding how our own experiences, even our generational experience, can impact our thinking and the way we invest. Just when you thought you really understood your own thinking, you might just need to think again. I hope you enjoy the video.
The last story I want to tell you today is that everyone has a different view of the world. And I want to start this by showing you the fatalities that took place during a bunch of well-known events in the United States and around the world. Hurricane Katrina in 2005 killed about 1,800 Americans. Pearl Harbor during World War II killed about 2,500 Americans. The September 11th terrorist attacks killed 3,000. Allied soldiers on D-Day, again during World War II, was about 4,400 fatalities. The next I want to show you is an estimate of the number of deaths that would take place during a rupture of the Cascadia subduction zone, which is a very specific kind of earthquake that would occur off the coast of Washington State near Seattle. Our best estimate, the baseline estimate, is that 16,000 Americans would die during this kind of earthquake. The best estimates for the odds that this will occur in the next 50 years are 1 in 10, which is a lot. Now, it turns out that when most people think about earthquake risk in the United States, they think of two cities, San Francisco and Los Angeles. But any way you look at the numbers, Seattle is at by far a bigger risk, the biggest risk of earthquake risk in the United States. The similar numbers for a major earthquake in San Francisco and Los Angeles are between 2,000 and 5,000 deaths. Seattle, it's 16,000, and it's a smaller city. And the reason that this number is so high, by and large, is not just because Seattle's geography predisposes it for a major earthquake. That's part of it. But most of the reason this number is so big is because any way you spin it, Seattle is not prepared for a major earthquake relative to San Francisco or Los Angeles. California has had a pretty good earthquake building code for skyscrapers since the 1930s. Washington State, by comparison, barely had any earthquake code that had teeth until the 1990s. California, decades ago, passed voter-approved bonds so that the owners of big skyscrapers could take out cheap loans to retrofit their buildings so that they can survive a big earthquake. Seattle and Washington State, by comparison, cannot even pass within its budget the ability to do a survey that maps out where all the high-risk buildings are even located. And you go on down the list, the preparedness among firefighters and emergency crews, much greater in California than it is in Washington. Mandates about signs and evacuation routes in hospitals and schools, much greater in California than it is in Seattle. And what's interesting about this is that the people of Seattle, where I happen to live, by the way, have the same data as anyone else in California. They love their families as much as anyone in California. But they've, by and large, done nothing to prepare for the next earthquake, while California has moved mountains to prepare for it. Why is that? I think the answer is this. California has lots of small and medium-sized earthquakes. So if you live in California, you are constantly being reminded, sometimes at 2 in the morning, being woken up shaking in your house, that earthquakes are a part of your life. You feel shaking on a maybe monthly basis if you live in some parts of California. It's just part of your life. Washington State, by comparison, does not have lots of small and medium-sized earthquakes. They have massive earthquakes that occur every few hundred years. And so if you live in Washington State, you don't have this part of your culture, this constant reminder, this constant being woken up shaking that earthquakes are part of your life, like you do in California. And what that shows is something that I think is really important, which is that when people think about risk, they don't do it in an analytical way. They don't just look at the data and then make their action based off the data. When people think about risk, they do it in a cultural way. And everything that you think is risky and your willingness to respond to risk and do something about potential risks is heavily tied to the culture of where you live and the generation you are from and the values that you were raised in, these kind of things that are not necessarily in our control. We want to think that risk is like a force of nature, that it applies to everyone indiscriminately, and it does. But that's not how people think about risk in the real world. Whenever people think about risk in the real world, they become heavily tied to the unique circumstances of their own lives, where they live, when they were born. And that is also true in investing. Let me show you what I mean. This shows the US stock market, what the US stock market did in your teens and 20s, your young and impressionable teens and 20s, when you're learning a baseline foundation of knowledge about how the world works, based on what year you were born. If you were born in 1970, the US stock market went up tenfold during your teens and 20s after inflation. That's an amazing return. If you were born in 1950, the market went nowhere during your teens and 20s. They earned a 0% return after inflation. I would just ask, do you think these two generations went through the rest of their life thinking the same thing about the stock market? That it was capable of delivering the same returns or had the same amount of risk involved in it? And the answer is no, of course not. It stuck with them for the rest of their lives. This is true for something like inflation as well. If you were born in the 1970s, inflation averaged about 8% per year. If you were born in the 2000s, it averaged about 2% per year. In the 1930s, during the Great Depression, it was negative 1% per year. And Venezuela, just in the last 2 years or so, was about 1,000,000% inflation. You can't even put a bar and go through the ceiling here. Again, do you think these generations think the same thing about inflation? They have the same data. They're just as smart as one another. But they think very differently about inflation just because of the dumb luck of their personal circumstances. Let me give you one other example, a very stark example. The unemployment rate in the United States in December of 2010 was 10%. That was the overall unemployment rate. But if you break that out by different economic groups, you see some enormous skews within there. During the same month, the unemployment rate for Caucasian females aged 45 and up with a college degree was 3.7%. At the same time, the unemployment rate for African American men aged 18 to 26 with no high school diploma was almost 50%. No one should think that these two groups should think about the economy in the same way, that they have the same economic outlook, that they think about risk and opportunity in the same way. They're seeing the world through a completely different lens because of this. Even if one group is just as smart as another, they have access to the same amount of data, they're seeing the world through a very different lens. Now, years ago, I interviewed Dr. Daniel Kahneman, and we talked about a study that a group of Stanford researchers did, where they looked at a bunch of brokerage account data, and they wanted to answer the question, how does this actually impact people's lives, how they invest? How does what we've experienced in life impact how we invest? And what this research showed was that if you grew up during the Great Depression, you were half as likely to invest in stocks compared to those who grew up in the 1960s. If you grew up in the 1970s when inflation was really high, you were 1/3 as likely to invest in bonds later in your life compared to those who grew up in the 1950s. If you grew up in the 1980s, you were twice as likely to buy stocks compared to those who grew up in the 1970s. And their big conclusion when they put all this together was, quote, our finding suggests that individual investors' willingness to bear risk depends on their personal history. Not on their intelligence, not on their data, not on who their financial advisor was, just the dumb luck of where and when they were born. And now during this conversation with Daniel Kahneman, he mentioned at one point that he's the biggest pessimist he's ever met. He said no one is more pessimistic on the outlook of humanity than he is. And I said, wow, that's astounding. Is that because you have all of this insight into our biases and how people think about risk all wrong? And he said, no. He said, I'm a pessimist because I grew up in Nazi-occupied France. And he said, I saw from an early age how evil people can be. And that, of course, is not an experience that I had. But that was his life. It was his experience. I can try to be open-minded and empathetic to something like that, but I don't have the emotional scar tissue of someone like himself or millions of other people who lived through that. And that's an extreme example, but I think we all have something like that. That whenever we're thinking about risk, we become prisoners to our past. And we think about risk in rational and unbiased ways, but no one does. We all just anchor to our personal histories. So we asked Kahneman, what can we do about this as investors? And true to his pessimistic self, he said, there's nothing you can do about it, just deal with it. But we pushed him a little bit further. And he said, okay, keep two things in mind. Number one, talk to as many people as you can as an investor, particularly investors from a different generation and different countries than your own. Because those are the people who've likely had different experiences than you as an investor. And therefore, they're likely to hopefully open your mind to the range of possibilities that you yourself might experience during your lifetime as an investor. The second thing that I think is so important here is realize that people who make different financial decisions than you are not always crazy. Investing is not like math where 2 + 2 = 4 for everyone. There's one right answer no matter who you are. Investing is a much more personal endeavor. And how I think about risk in my own household is different than how you think about it. Not because either one of us is smarter than one another, just because we're different people. I think a big realization in understanding behavioral finance and the psychology of money is realizing that personal finance is very personal. And you need to become introspective about who you are, what your risk tolerance is, what your goals are, what you really want out of life, and realize that those decisions might be different from other people around you, and that there is no one right answer that any of us can anchor on. And so if there's a common denominator of these stories today, it's that when people tend to think about risk in the economy and in their investments, they tend to think about what's going to happen to them. What's the stock market going to do to me? What's the economy going to do to me? That's how most people think about risk. I've always thought that a better way to think about risk is just not what's going to happen to you, but what you do to yourself. It's your own biases, your own misconceptions, your own impatience, anchoring to the unique parts of your own life. That's your biggest risk as an investor. And a lot of investors don't want to hear that you're your own worst enemy as an investor. But I've often thought it's actually a pretty optimistic realization. Because, of course, you have no control over what the market's going to do next or what the economy is going to do next. The only thing you have control over as an investor is your own behavior. And when you realize that behavior is actually also the most important part of investing success, that's actually pretty optimistic. So I want to close today with an investor named Bill Bonner, who has a quote that I love, who says, people do not get what they want or what they expect from investing. They get what they deserve. Not about how smart you are. It's just about how you behave. Thank you very much.